Hello and welcome to Chapter 13, Statement of Cash Flow. So our learning objectives for this is to describe the content and format of our Statement of Cash Flow. We will be preparing our operating section of the Statement of Cash Flow using the indirect method. We will be preparing the investing activities section as well as the financing activities section using the same indirect method. Not to say that they are any different under direct or indirect method. Those two pieces, investing and financing, remains the same. So our general purpose of statement of financial position is the users want to look at how is the company generating cash? Where is that cash coming from and how is that cash being utilized? They want to know if the company has the ability to generate cash in future. Okay, is the cash coming from their operation or is the cash coming from their financing activities? How are they using it? Are they spending too much on their investing? Okay, so all of that information or determination can be made from your statement of cash flow. So your investing and financing transaction during the period and the effect upon the capital structure can be gauged from your financial statement. Now, when it comes to the statement of cash flow, it is broken down into three main categories. There are operating activities, investing activities, and financing activities. So the operating activities is something that comes from the day-to-day operations, something that a business does. So let's say if we are thinking of the bakery shop, the revenues and expenses that the company is generating from that day-to-day operations is your operating activities. So we will look at inflow and outflow of cash with regards to that operating activities. So inflow of cash will be the sale of baked goods, and the outflow of cash will be the salaries that we have to pay, the utilities expenses, and the other charges that we pay. Okay, so payment for the raw material. So those are your cash outflows. When you are looking at the statement of cash flow, we are only capturing the cash inflows as well as the cash outflows. Any transaction that is not cash relevant would not be reported on this financial statement. So what we need in order to prepare our statement of cash flow is the income statement as well as your balance sheet. So we will start with the income statement, but we would also capture the changes in the current asset and current liability accounts because those accounts are also an extension of your day-to-day operations. Investing activity is when the company is either purchasing or disposing of long-term assets or investments. So if you conceptualize your statement of financial position or balance sheet, then on the asset side, outside of the current assets section, any other asset that you see on the asset section will be accounted for under the investing activities. So if you are spending the cash on purchasing new equipment, then that is cash outflow. If you are selling your investments that you had, then that is cash inflow. So current asset, the changes in the current asset will be captured in operating section of your cash flow, but all the other assets outside of current asset listed on your balance sheet will be captured into your investing activities for your cash inflow and outflow. Then thinking of your balance sheet or your statement of financial position. So the only thing that is left on that is then your long-term debt and equity, because your current liability or your current debt is accounted for under the operating section. So your long-term debt and your equity changes are then going into your financing activity. So inflows and outflows of cash on the financing activities. Let's say if the company took on more debt, then that is debt financing. The cash would have come in, so that will be cash inflow. When you are paying that debt off, then that's the cash outflow for the business. If the company is issuing out more shares, that is inflow of cash. When they are paying out dividends, that is outflow of cash. When the company retires the shares or buys them back, that is outflow of cash. Okay, so any changes in the long-term liabilities and the equity accounts are then accounted for under the financing activities. So significant non-cash transaction, if we come across any transaction that is non-cash in nature, then that transaction will not be reported on the face of your financial statement. Since these transactions are significant, we will report them into the notes to our financial statements. So items such as issuance of your shares to purchase an asset. So this is a barter transaction, or you are reducing a liability, or there is a conversion of debt into equity. So a debt item has been converted into shares. There has been exchange of property, plant, equipment for shares. Okay, so all of these are non-cash transactions. So anything that's non-cash but relevant will go into the notes to your financial statements, and we will talk more about that in E13-1. So this is what your statement of cash flow format looks like. So in the title, we have the name of the company, name of the financial statement, and the period this is covering. Either a year-end or month end or quarter end, something has to end. So the three main categories of your cash flow statement, as you see here, are your operating activities, investing activities, and financing activities, and they are always listed in the same order. So let's not change the order of these. So operating, investing, and then financing. And finally, the good thing with your statement of cash flow is you already know the bottom three lines that are highlighted in red here. So your cash at the end of the period is coming from your statement of financial position. Your statement of financial position is always comparative. It will give you 2 years numbers. So let's say you are preparing the financial statement for 2019. So your ending cash balance is what you will see at the end of 2019. Your beginning cash balance is what you had at the end of 2018, which becomes beginning for 2019. So we already have the beginning and ending cash balance coming from your statement of financial position. The difference in the beginning and ending cash balance is really what that net increase or decrease in cash is. So we already know what is it that we are trying to explain, but we just need to be able to reflect that cash and explain where it's coming from. How is that cash coming from operating, investing, or financing, or is being used up in any of those activities? So these are the primary 4 steps that we will go through. We will first prepare the statement, the operating section, then we will prepare the investing section, then financing, and finally the last 3 lines, which is completing the statement of cash flow. Now, there are 2 ways that the statement of cash flow can be prepared. There is a direct method and there is an indirect method. Now, indirect method is what we will be focusing on in this course, but the direct method is not covered. The only thing that is different between the direct and indirect method is how the operating section is prepared. When it comes to investing and financing section, that does not change under either of those methods. It's exactly the same. The way your operating section is presented is a little bit different with regards to direct and indirect method. We will be focusing on indirect. Now, as we said earlier, in order for us to prepare our statement of cash flow, we are going to need our income statement and we will need our balance sheet or your statement of financial position. But we also know that the income statement is based on the accrual basis of accounting. It's not tied to cash movement. We record the revenues when they are earned and we record the expenses when they are incurred, right? But the statement of cash flow is strictly to do with the cash movement, whether the cash is coming in or cash is going out. So one of the first thing that we have to do under the indirect method is to go ahead and start with the net income that comes from your income statement, but then we will have to adjust for non-cash transactions such as depreciation, gains and losses, or bad debt expense. Okay, those are non-cash transactions that are sitting onto your income statement, so we will have to adjust for non-cash transactions. So we will have to undo them. So when you are trying to undo those transactions, always think of how was this originally treated and do the exact opposite. So if you think of your depreciation expense, the depreciation expense would have been deducted to get to your net income. Here we will just add it back to undo the effect. So it washes out, it's in and out. We will also account for the changes in current asset and current liability accounts. And I'll show you a quick tool on how to deal with those changes. But anything that you see in your current assets and current liabilities, such as your accounts receivable, accounts payable, inventory, salaries payable, if you technically think of those accounts, anything and everything that you see in current assets and current liabilities is really part of your ongoing operations. So we will track the changes in those accounts and adjust them under the operating section, under the indirect method. Now, indirect method is fairly popular in the industry because it's relatively easy to use, first of all. Secondly, it does not give a whole lot of information about the company to the outside users. Okay, companies want to protect their interests, so they want to make sure that there is not too much information that's published out into the market. So this is a quick guide to remember what to do with your current asset and current liability changes. So think of MIA. If you see your current assets are increasing, then we will go ahead and deduct that. And I will recap all of that at the end with another pictorial presentation. So we'll talk about it there as well. So this is what our statement of cash flow under the indirect method looks like. So name of the business, name of the financial statement. Here they have indicated the method they are using and for the year ended December 31st, 2021. So they are starting with the net income of $145,000, and then they are adjusting for all of the non-cash transactions that were on the income statement, such as their depreciation expense, which was deducted on income statement or the statement of income, and now it's being added back. The loss would have been deducted on statement of income. Now it's added here. Okay, losses and gains, they are all non-cash transactions as well. Then we are accounting for the changes in increases or decreases of your current asset or current liability. So we will use our tool of MIA, which was minus increase in asset, to determine whether to add those differences or deduct them. Once you account for everything, that is your net cash provided or used by the operating activity, which in this case happens to be $163,000. The investing activities, as we had said earlier, is the changes in your asset accounts. All the assets except your current asset. So if we are buying new assets, then that is cash outflow. And if we are retiring or selling those assets, then that's the cash inflow. Depreciation expense, as we said, is a non-cash transaction, but that is also captured in the operating section. So this is what the investing activity section would look like. So we are spending $120,000 on purchasing a building in this case. The land was purchased for $95,000 and equipment for $25,000. We also had an old equipment that was sold for $4,000, so that's incoming cash. So we ended up using net cash in the investing activities section for $236,000. Okay, down below, they have given us the notes disclosure that is for the significant non-cash investing and financing activity. So a portion of $110,000 of land purchased acquired by issuing common shares. So this is significant non-cash transaction and is disclosed in the notes to your financial statement. And finally, we have our financing activities. This is the changes in your long-term liability as well as your equity accounts. So the changes to notes, loans, bonds payable, they are all analyzed here. So if we are taking on more debt, then the cash is coming in. If we are making dividend payments or paying off this debt, then that's cash outflow. So any changes in the long-term debt and equity accounts will then be captured in our financing activities section, and it looks something like this. So addition of the mortgage payable, so they have taken a new mortgage, which is bringing in cash of $124,000. They have repayment done in the period on the mortgage for $6,000, that is cash outflow. They have issued more common shares, which brought in $5,000 cash, and they have paid $28,000 in dividend to shareholders, which nets out their cash provided from financing activities of $95,000. Again, there is a notes disclosure with regards to that barter transaction where a portion of $110,000 of land was purchased, acquired by issuing common shares. So then finally, we complete our statement of cash flow, which is step 4, by looking at the beginning balance of the cash account, ending balance of the cash account, and figuring out the difference in that. So your total of operating activities, investing and financing should be the same as the change in the beginning cash balance and the ending cash balance. This is what your complete statement of cash flow under the indirect method will look like. So first you're looking at the operating section, then the investing, then financing, and finally, so the addition of operating, investing, and financing should be a net increase in the cash of $22,000, which if you look at it, at the beginning of the year, the total cash was $33,000. At the end of the year, which is on December 31st, they had a total cash of $55,000. So their net increase was $22,000. So those 3 lines is really something that you start with. And then there is a notes disclosure on this financial statement with regards to a barter transaction for the land and common shares that was done. So in class, we will be looking at these financial statements to prepare our statement of cash flow. And finally, my friends, this is the comparison between IFRS and ASPE when it comes to statement of cash flow. Thank you for listening. Hello, everyone. So this is the quick recap of Chapter 13. So as we said, we need our statement of income, balance sheet, or your statement of financial position, and the notes in order to prepare our statement of cash flow. So the changes in the net income or the total net income that we have becomes the starting point for our operating section when we are preparing our statement of cash flow. We will be recording the changes in current asset and current liabilities into the operating section as well. So the quick tool to remember that is MIA. So there are 2 categories of your items. So there is current assets and current liabilities. The only thing that can happen with these asset and liabilities is whether they can go up or they can go down. If our current assets are increasing, then we will take the difference and deduct it out of our operating section to adjust for the increase. If the current liabilities decrease, then we would add the difference. Likewise, with your current liabilities, if they are increasing, then you would add, and if they are decreasing, you would deduct. The changes in your property, plant, equipment, intangible investments, and other assets. So basically, any asset account outside of current asset, changes in that will be captured into your investing section, and your changes in the long-term liability and equity account will be captured in your financing section.